Let's connect with the management of Honasa Consumer, and it's been a turnaround quarter for them. Ramanpreet Sohi, Chief Financial Officer of Honasa, joins us now. It's been a good all-round performance for you, at least for the quarter gone by. Directionally, things are moving in the spirit. I want to first understand with the growth what you've reported. Revenue growth of 20%, and volume growth number which you've reported for the first time also is 20% plus. 20%, will that sustain for FY25, and are we likely to see a built-up on that?
Yeah, hi, good morning to you. Thanks for having me. No, of course, I think, from a quarter perspective, a pretty decent quarter for us. We've delivered about 23% value growth, and in fact, volume growth is coming at 27%. And in fact, for the year, our volume growth was in fact about 40%, and a value growth for a year perspective was plus 30%. Yes, I think from the way our business is shaping up, the way we are looking at and going deeper from a distribution perspective, building our younger brands, we are very confident of delivering plus 20% kind of value growth for the coming year.
Right. Ramanpreet, hi, morning. But tell me, you had guided for that 28.6% year-on-year growth, right, in FY24. Your growth is slightly lower than what you had guided, because you had guided about 30%, if I'm not mistaken, for FY24. And then what's the guidance for FY25?
Yeah, so 24, we've delivered 30%. So in fact, if I'm not wrong, in line with our guidance, or in fact, a little better than our guidance is how we see it. And from a 25 perspective, what we've been consistently guiding the street has been plus 20% growth. In fact, for next 3 years, our guidance is plus 20% CAGR.
I'm looking at your EBITDA guidance, and you are guiding for an EBITDA margin expansion of about 150 bips, 1.5%. But if you're confident of a 20% growth, and if your advertising and promotion expenses are coming under check, then why are you being conservative with your EBITDA guidance? Because the way it would work is the operating leverage benefit would kick in, financial leverage benefit would kick in. So the margin expansion has to be at least 3 to 4%. Are you being conservative with your margin expansion guidance?
Yeah, so if you actually see this year, we've actually improved our operating efficiency by almost close to 500 bips from a year-on-year perspective. We've delivered a 7% EBITDA for the year, and we're looking at about 150 bips expansion into next year. Now, of course, out of this, two-thirds of this will be driven by marketing and A&P efficiencies. I think one thing that everyone needs to understand is that we're building a house of brands. So we have Mamaearth, which is a large 1,000 crore plus brand, and then we have a set of in fact six new brands that we've launched over the last 3 years, which are in different phases in the journey, and hence those brands need investments. And at an overall level, directionally, we continue to improve and scale the business efficiently, unlocking margins, and hence sort of deliver a strong 20% plus kind of a top line CAGR. So, given where the brands are in their journey, they would need investments. But at an overall level, we're still delivering efficient growth and faster profitable growth.
Okay, wanted to get in a perspective from you as well. There are a lot of emerging brands as well. What's next in line to hit that 500 crore ARR? Do you have any timeline?
Yeah, so as you know, so we'd hit a 500 crore in annual run rate with our second brand, Damako, earlier this year, and in fact, the brand has been profitable through the year as well. So we've actually executed a scale up of a brand to 500 crore run rate and also profitably. We have, we see clear signs of the other younger brands, Dr. Shade, and Ecologica, which are very differentiated propositions. We likely that over the next 3 to 4 years, we see them also hit a 500 crore run rate. So I think we're building these brands in the right direction. We are very confident and hopeful in terms of our experience of scaling and building brands. We should be able to replicate our playbook, leverage our capabilities and skill sets to also enable the younger brands to hit that run rate.
Tell me, which is your other emerging brand where you think which could be next in line to hit that 500 crore rupee ARR?
Like I mentioned, Dr. Shade, which is a botanical plus actives, proposition, skincare brand, and Ecologica, which is a hydration-based proposition. Both these brands are, headed in the right direction. Our last reported run rates for these were about 150 and 180 crores in annual run rate. And since then, they've also been scaling in the right direction. So, over next, 3 odd years, we expect the brands to hit a 500 crore run rate as well.
Let me address the stock market view here. Honasa is growing. The growth will be higher than the industry average. That's largely because of the base. But if one looks at mature FMCG companies, the return ratios and EBITDA margins are north of 20, north of 25%. In how many years you think you will be able to reach what could be called as industry average, not in terms of growth, but in terms of comparable margins?
So I think when it comes to operating margins, we think we should be able to do a double-digit EBITDA in a couple of years from now. And I think it's important to actually see our business as sum of parts. So a brand like Mamaearth, which is of course much more scaled up, that's already at a double-digit EBITDA profile. And younger brands are of course like I mentioned earlier, a 500 crore run rate brand like Damaco is a break-even profitability. We've clearly seen as brands scale, they're scaling efficiently, and hence I think in terms of trajectory, we continue to add at least 150 bips of expansion on a year-on-year basis. So, next year, if we sort of add 150 and then another 150, we should be at a double-digit profile. Sort of when it comes to, let's say, return ratios, we probably would be about 10% ROCE today. But very clearly, as profitable growth is shaping up, our ROCs will be competitive in the market over the next couple of years.
How much of your growth in next 3 years will be inorganic and how much could be purely driven by your own brands?
Very difficult to say. Currently, we're very sort of the guidance that we're giving, we are hopeful that this will be primarily organic growth. Now, if we actually, if we come across an opportunity which kind of is complementary to our portfolio, that's when we'll evaluate and see. But currently, there's nothing on the table, and the growth guidance that we are working towards is primarily organic.
Let's also understand what the outlook is in terms of the offline quality of distribution. Can you just tell us a little bit about, what the company's strategy is on that front? Is that in any way going to impact your margins?
Yeah, in fact, in terms of the channel mix, offline is about 35% of overall business. It's a 3-year-old channel for us. Primarily, Mamaearth is how through which we're building this channel. We've in fact given we've been a young brand and it's a young channel for us. We've actually seen a little bit of a transition. In fact, as we speak, we are in the middle of distribution transition where we are moving our top 50 cities to direct distribution. We've actually been able to transition top 10 cities to direct distribution model, moving out of super stockist model to a direct distributor model, which enables us to have much better control on our distribution. In market execution, quality will also improve. We're also, over a period of time, working with better quality tier 1 distributors, more process-oriented distributors. Distributors we're open to using systems which enable us to give clear visibility, data visibility, and take more effective decisions as we expand our distribution. So I think we're in the middle of that transition, and hopefully by Q3 of this year we should be able to complete a transition wherein 50%, top 50 towns would be directly we'll have a direct distribution model wherein we'll remove the super stockist layer and we'll have a distributor. We'll distribute directly through our distributor to the markets and also cover our outlets more directly. Today, if we reach close to 200,000 retail touch points, out of that, almost 70% of that is indirect reach, and hence over a period of time, we want to ensure that 70% of our coverage is a direct reach. So we're in the middle of transition. We've done some corrections during the year, and we're hopeful that by Q3 we're stabilized on our offline distribution, and we continue to further expand our distribution and move into newer towns as well.
Follow-up questions for you. Can you give me a split of your mix in terms of the channel mix? How much is e-commerce? How much is quick commerce? How much is pure distribution led?
Yeah, so offline is about 35% and balance is online. Which is of course a mix of e-commerce, quick commerce, and our own direct-to-consumer channel. Quick commerce, of course, is still very young, but it's of course growing, 4 to 5 times faster than other platforms, given the acceptance of the channel. And of course, that channel is also more profitable for us in terms of how it is structured. So I think that's it's a very good sign for us in terms of how quick commerce is scaling in our country.
Honasa started with one homegrown brand. I mean, it's such an exciting story that you feel so proud when you talk about it. And then you expanded into new categories. Will that be the linear model that you will be experimenting with more and more new categories? You will remain a cosmetic company, but you would add more layers of cosmetic products?
Yeah, absolutely. So I think we are clearly focused on beauty and personal care as a house of brand. We have today 6 brands with differentiated propositions across the spectrum of beauty and personal care categories. Depending on the proposition of the brand, if we think the brand has a right to win in a certain category, we will approach that category with that brand. For example, with Mama Earth, we extended into personal wash earlier this year. We've also announced the launch of a new brand called Stays in the color cosmetic space. So yes, so I think that's the direction, and but we'll continue to sort of win our customer love, consumer love in the broader beauty and personal care categories.
Good luck with that. Thank you so much then, Ramanpreet, for taking the time out and speaking with us today.
Thank you so much. Thanks.
Well, Honasa, clearly a star performer today. The stock holding out very nicely. In fact, about a 2.5% uptick is what it's sitting on, as the rest of the market as well.
If you like this video, then like, share and subscribe to ET Now.